Well, hello everyone. Welcome to Getting Started with Technical Analysis. Today we are talking about popular technical indicators. And please, I'm emphasizing the popular here because there are literally hundreds of indicators out there. And so we're going to talk about the ones that are most often used. If you're brand new to the world of investing, brand new to the world of trading, and you look at a chart and you know that there are nuggets of wisdom. There are perhaps little messages on those charts for you, and you aren't quite sure of how to interpret them. Well, you're in exactly the right place, because that's what technical analysis is all about, is understanding the story that the charts are trying to tell us. And sometimes, they start to tell us a story and kind of change their mind partway through, and that's part of technical analysis also. But today we're going to look at some of these technical indicators. My name is Barbara Armstrong. I'm a coach with Schwab, and my handle at Barbara Armstrong CS. I invite you to follow me over in the land of X, formerly known as Twitter. Just know we're going to look at a whole bunch of charts today. We're going to place an example trade, but know that what we talk about here is for example purposes only, not to be construed as a recommendation in any way, shape, or form. If we do an options example, know that options carry a high level of risk and aren't suitable for all investors. So we need to take that into account as well. We use the paperMoney software application on the thinkorswim desktop platform. It is a brilliant place to learn and to start to hone your skills. Become familiar with how to place a trade on the platform, but maybe more importantly, make sure that you understand the trading strategy that you are considering trading, that you have a plan in place, and that you know what you're going to do, both if the trade goes for you and particularly if it does not. Now, this class focuses on technical analysis, but that doesn't mean that Schwab recommends that technical analysis is your sole means of investment research. They certainly don't recommend that. So you want to be aware of the fundamentals of what's happening during earnings season. You want to be aware of what's happening globally in the markets and here at home. And, this year we've spent a lot of time talking about tariffs, for example. So there's that. Okay. So, I'm just bringing out my drawing tool here. We kind of rebooted this course at the beginning of this year. And, we have gone through, whoops, I guess that's black isn't the best color when you're kind of working on black, right? And we are already almost through this class for the second rotation. And we officially have a 9-week rotation here. I'm going to throw in a week 10, which is an introduction to Fibonacci's. But, and then we'll go back to the beginning and we'll roll through the entire series again. And every time we do, different things are happening in the markets. And if I'm away, there might be a different person teaching it, which can, bring a new perspective. So when I taught Getting Started with Options, there were people that had gone through the whole series, 1, 2, 6, 8, 10 times. And I would have been one of them had I been a client and had that class been available to me. And it was seeing charts for the first time that really brought all this to life for me. So there you go. So if you're new to this and you want to do some binge learning as opposed to binge watching on Netflix, you can go back and tap into the whole series. And the way you do that is to come here. If you haven't subscribed to the Trader Talks channel from Schwab Coaching on YouTube, you'll want to do that. When you get here, the first thing that will come up when you come to the home page is the class that's currently being taught. And so when that comes up, you can just click on that if you want to join, or if you come to playlists, and I'm not sure why, but the Getting Started series tend to be at the very bottom of the playlist. But when we come down here to Getting Started with Technical Analysis, you can see that they're kind of listed. We started back here with the basics of technical analysis, just over a month ago, now 7 weeks ago. and, and then went to trends, support and resistance. We did a whole week on candlestick patterns. And then interspersed, I've done some short videos, which are also in the trade management mini session playlist. And these are like 3 to 5 minutes, and each one is a different individual candlestick pattern. Okay, so you can tap into those. Also, just while I'm over here, if you have never attended an in-person workshop, they are fantastic. Like when I was a client, I would get in my car and drive, or get on a plane and fly across the country. And a lot of people are flying in this weekend for the first market drive of the year in Miami. It starts with a look at what's happening globally in the markets, comes down to what's happening within our country. Again, there might be some conversation around tariffs and their impact on the market. And then it comes right down to how is that impacting individual sectors in the market, like the consumer discretionary sector or the financial sector. And then they might even look at, they will look at individual stocks and how a trader, they'll look at some examples on how you might, choose to try and take advantage of an individual stock and what's going on with it, based on what's happening in the market. So it's a really interesting a process that they go through. And certainly if you're within striking distance of Miami, I think there's a few spots left. So you're welcome to join us there. It will be Ben Watson and a cast that has flown in from all over the country to serve you, and they do a great job. They'll provide breakfast, lunch, and a great cocktail hour with fabulous hors d'oeuvres at the end of it. And then if you can't make Miami, you're welcome to join us in New York. I will be at the New York event. Ben will be at all of these. Santa Clara is already like bursting at the seams. We've closed registration for that. If you show up, I have a feeling they'd find you a spot. But you're way better to just register early so that we know we have a spot for you. And then we're back in New York. And I mean, you can look at the schedule is posted right out through the end of the year. Okay. Yeah. So there we have it. Okay. So let's get back to our regular programming. I just didn't want to forget to mention that, because I think those are additional resources and they're free. I mean, they certainly aren't free to put us on. You don't want to, the bill would make you, twitch. I think if you saw the bill for us to host you at these things, but you're our clients and you're absolutely worth it. And trust me, you will feel special when you attend these events. So what we're going to look at is what technical indicators are. We're going to look at some common types of technical indicators. And I'm underlining the word common. Now, when I joined the coaching team, I was introduced to the world of investing in 2011. And when I joined the coaching team in 2016, we used to be able to talk to clients individually. And I got this question about a Darvis indicator, and I'd never heard of it. And so I'm asking, there were 30 or 40 coaches at that time. I said, anybody ever heard of a Darvis indicator? And it was, created by some guy who was a professional ballroom dancer, and no one had ever heard of it. So I am never going to talk in this class or in any class about an indicator that, most of us have never heard of. We're going to talk about the ones that many traders embrace and use. And typically, if a lot of people use an indicator, there's usually a reason for that, right? Right. So there we go. So we're going to look at some common indicators. We're going to, look at moving averages, things like the MACD and the RSI. I'm also going to bring up the average true range indicator, because I've used that a lot in my classes. And there's a coach, his name is Scott Thompson, and he's now actually back teaching one class, but he used to have a class on Fridays, and it was just based on this one ATR trading strategy. And we've used that a lot in our trading a smaller account and long options classes. So I thought I'd go over that one as well. And these, signals can be both bullish and bearish, right? Right. I think we all know that. Okay, so, there are, like I said, hundreds of technical indicators out there. And, they've been created to address a range of trading styles, and they can be used in multiple time frames. So if you're a short-term trader, you can use that on a chart where you're looking at maybe, 3 months. You can use it on a 2-year weekly chart. You can use it on a 10-year monthly chart. And there are really two basic categories. There are trend indicators and oscillating indicators, which are also known as momentum indicators. And the trend indicators we tend to see overlaid on the chart, something like a 30-day moving average or a 50-day moving average. And then oscillating indicators are typically shown in a window below the chart. Okay. AP 514, if you're going to Houston, I need to get there because you've been attending our classes for so long. I just feel like we have to meet, so, okay, Houston, I got to put it on my list. Okay, so, and what are technical indicators? So these are things like the MACD, the stochastics, relative strength. These are all different technical indicators. And what they try and do is provide clarity of price position and trend, or maybe confirmation of what you're seeing, on the screen when you look up and you're looking at the actual chart. And they're commonly constructed using historical price activity and volume levels, or sometimes a combination of both. Okay. Excuse me. Ooh. I tried to make that a delicate sneeze. I have many things in my repertoire. Delicate sneeze doesn't tend to be one of them. So here's an example of a trend indicator, a simple moving average. And if you've attended any classes, you've probably seen moving averages on the chart. And they can be a simple moving average or an exponential moving average. So a simple moving average is calculated by taking the closing price for a stock over a particular time frame. I don't know why that keeps coming up. There we go. So we're looking at the average closing price over a selected time frame. And that's what creates this line on the chart. So if this is a 30-day, and on my charts, I tend to have a 10-day moving average, a simple moving average, and a 30-day moving average. Now, some prefer 20 and 50. It's just a matter of personal preference. Now, why did I choose these? Well, in all honesty, when I became a client, the first classes I attended, that coach used a 10-day simple moving average, and he had that line blue. And so I make my line blue, and 30-day moving average, which he had red. And so I just made my chart look the same. I found it made it easier for me to learn. But you might over time find, maybe you do longer term trading. So a 10-day SMA is just busying up your chart and you don't really need it. Maybe you want a 30 and 100-day. So you'll find what works for you. Okay. Now, what's the difference between a simple moving average and an exponential moving average? Well, with a simple day moving average, they are going to take the last 10 days, the closing price on the last 10 days, and they're going to add them all up and divide by 10. And it's pretty simple. Okay. And then with the exponential moving average, they're going to kind of give more weight. If it's a 10-day, they're going to say, okay, I'm going to give this one, this one, this one, and then I'm going to give this one a little more weight. So it's kind of skewed to the end. And so it moves a little faster. And we'll go out and look at that on the chart. And unless there's really big movement on something, so we'll use UNH as our example. So we'll come and we'll look at UNH. Okay. So, and, we're going to see this as being bullish if this simple moving average is uptrending as it is on this chart, and bearish if it's going in the other direction, if it's downtrending. And we read charts from left to right the same way we would read a book, right? And so some traders might use trend or a particular trend line as a way to target entries and exit. So, trade signals, entries and exits. And so the very first trading plan that I learned for a stock was if something crosses the 30-day, so let's assume this is the 30-day moving average, we might, wait for it to cross, come back and retest. And so this here might have been our entry day. Right here on this day here. So it crossed the river, came back to test the ice, and then it bounced. And if we wanted to be in this for a longer term, we might even put our first stop down here. And then when it came up, so then it starts to uptrend. And I'm a big fan of, when to get out before you get in. And so we're saying, okay, if it keeps going up, we want to stay in. If it comes back below here, we're going to adjust our stop. So it goes up, comes back, touches our 30-day, and if it closed below, let's just assume it closed below here, we would move our stop from here. We'd get rid of that. Sorry. We'd move our stop up to here. And then it came up and hit it again. If this was higher, it looks like it's a little bit higher, we'd move our stop up to here. And as an example, I usually use 3%. You could use 2%. You could use 5%, whatever seems to work for you. And then it came down and it didn't close below the 30-day moving average, but it kind of waved. It kind of came back and waved. And so you might say, I've got a fairly big gain here. I entered the trade on this day. So if it came all the way back here, I might be out for a slight loss, but I want to try and now preserve some of this profit I've made. So when it came down here and moved back up, I might just say, well, this 30-day moving average still seems to be acting as a support level. I'm going to move my stop up here. And then when it came down here, it's really on a tear. And this 30-day moving average, it's been moving up so aggressively. But now what we've done is, we've gone from defining a potential loss to trying to protect some of our profit here. Okay, and so just because we're in something for the long term doesn't mean we aren't going to manage it and look at this weekly or monthly or whatever your routine is. Okay. So this is how we can use something as simple as a simple moving average. Okay. And I've already pointed this out, we may say, hey, we want to get in when it crosses our 30-day moving average. And we may say, so let's say this is the same stock and it's been going up to beat the band. And, all of a sudden it comes down and we might say, hey, we've had a really nice run with this, but it's come up here, it's falling down again. And maybe our rule is if it closes below the 30-day moving average or the 50-day, whatever you want to use, we're going to set our stop 3% below. And so if we did that on this day, I don't know if we would have been out or not, but let's assume we didn't get out. So let's assume that our stop was right about here and we didn't get quite out. And then here, if we we closed again below the 30-day moving average. So if we put our stop, we'd move our stop up and we'd have ended up out of that position probably somewhere around there. And then you might say, well, when might I get back in? Well, this, had a great fall, right? Like it started falling and kind of kept falling. And if our entry rule is we want to see it go back across the 30-day moving average and come back and retest, we might not have got back in until here. And depending on how often we look at our positions, it only rose for one day off that, and then looks like it may be continuing to fall. So if we got in on this day, we may not be in very long. But the idea of letting it cross and come back and retest, it's, was this a legitimate breakout or a fake out? And so you may say, but I love this company. Well, you can love this company all you want, but what you may say is, I love it, but until it meets my rules to re-enter, I'm adjusting my stop. If I get stopped out, then I'm cheering it on from the sidelines. Okay. If you're a stock investor. All righty. Oh man, time is flying. Okay, so let's look at a couple of other charts here. So here's our MACD. And our MACD stands for moving average convergence divergence. And it uses the distance between two moving averages. The default is, I think, a 12 and a 26 day exponential moving average. And then it charts it as a bar chart to just make it kind of easier to see. And it oscillates from red, where the sellers are in charge, to green, where the buyers are in charge. And you can end up, you have a choice. You can have buy and sell signals added to your charts if you want. And I'll show you how to do that. And so, because one of those example trading plans I had said, hey, when it crosses here this way, this would be a red arrow, which would indicate you may want to adjust your stop. And this would be a green arrow, which is you may want to consider adding to your portfolio. Okay, and we call this here, this midline, the signal line. And that's a horizontal line. And some might use this to confirm a trade signal that they see on the chart. But as with many indicators, the MACD is going to be a lagging indicator. And so sometimes it takes a couple of days to catch up. Then we've got the relative strength indicator, and we have a line at 30 and a line at 70. And, these are considered to be this 30, a selling line, or, a buying line when it crosses above the 30 to be, this has been beaten up, maybe now is a time to buy. And when it's above the 70, some might say, hey, it's in pretty high territory here, might be considered overbought. Some might consider doing a little bit of profit taking if it closes back below that 70 line. Okay, so the 30 is considered to be an oversold line. So, hey, something may be on sale, so to speak. And you've got to watch when things are on sale, because sometimes they're on sale, for a reason. And sometimes when something's overbought, it's, over 70, when it's above that 70, it's overbought for a reason. Okay, but this is a commonly used indicator. And if you go to your studies, if you just type in RSI, you'll get this indicator. Okay. Okay, so let's go out and look at the charts. So on Cisco, I just have a 30-day moving average. And so if we were to use, Cisco as an example, back a year ago, it was kind of going sideways. And then must have been a positive earnings announcement, it gapped up. And if you were waiting for it to retest, you may have said, well, here was my retest, or you may have waited till it came back here. But let's just assume that we decided to buy right here. Oh, my lines. Now, this line, the default is now black. So if you want to make that different, you know, you can change it here and then make that a default. So let's just say we bought it on this day, and I'm going to get rid of these other lines. So we bought it on this day, and maybe we put our stop just 3% below our 30-day moving average. And I'm probably going a little too wide there. And then it came up, and, you know, it didn't quite close below, but it came up and kissed it. So maybe we moved our stop up on that day to here. And then it came back and it didn't close quite below, but you know, somebody who's watching it diligently might have said, you know, it touched the 30-day moving average. And others might just say, hey, unless it closes below, I don't care. You know, I'm just going to let it ride and not adjust my stop. But if we bought it on this day here, we've gone from trying to manage the damage if we were incorrect and the trade goes against us to moving, you know, up and now trying to protect some of our profit. And then we'd move it up again, and then again on this date, and then again here, and then maybe again here, and then we probably would have been stopped out here. And we can see that this 30-day moving average has been kind of acting as a support level. And if you're wondering where these red and green arrows came from, well, when I came to my studies, and edit studies, you'll see this simple moving average and it says close 30 and yes. This says show breakout signals. So if you click yes, then it'll give you a red or green arrow whenever the stock crosses either above or below. So that's why we had a green arrow here and a red arrow here and a red arrow here. And so if we got out, we now see this 30-day moving average acting as a ceiling rather than a floor. And then, you know, if our rule is we want to wait for it to cross back above and then come back and test the ice, maybe we got in somewhere around here again. But, you know, we were in it from here to here and had a nice gain theoretically. And we got back in here and looks like we'd still be in it. Okay. Any questions on that? Now, one of the things I said I would show you, and I'm just going to clear that drawing set, is if we come to studies and we wanted to add an exponential moving average, exponential or EMA, moving average. I had it up here earlier. I know we can bring an exponential moving average up. Okay, well, I don't want to. Reverse EMA. On reverse. Oh, it's because I'm on strategies. That's why. Exponential moving average. So if I add this and then we come in and we make this 30 just so that we can compare it. I was on strategies instead of studies, guys. That's why. And let's just make this dotted. So you can see that when I make this moving average exponential, as opposed to a regular 30-day moving average, it tends to drop faster when things drop dramatically. Like if we bring up UNH, we can see this line starts to fall a little faster because it's giving more weight to the most recent candles, but it's not a super dramatic difference, but it is a difference. And it's just personal preference. You'll see even amongst the coaches at Schwab that some coaches tend to use an exponential moving average and others will use a simple moving average. I try and keep things simple, so I'm a simple moving average girl. Okay, so another study I wanted to talk about briefly was ATR. So with ATR, and ATR might be something that you consider. I brought up the stock. Today, I'm having a day, folks. So if you come to ATR, if you click on this little question mark, it'll give you a very specific definition of what ATR is. But basically, what ATR tells us is how much this stock has moved on average over the last 14 days, from top to bottom, from high to low. So if I add, and this is an indicator that shows up at the bottom of our charts, we can see if we come and we look at CVX, for example, and we see, here's a stock that was kind of all over the place, right? And then it had this big drop and it's consolidated. So we have kind of this double bottom pattern and it's breaking out. So if you say, well, I'm not sure, what's going to be happening a month from now, but it looks like it might go up for the next couple of days. And so if a trader wanted to do a short-term trade, they might use something like average true range as a way of establishing a target. And this tells us that it's looking at the last 14 days. And then when we hover over today, it's saying, hey, on an average day, this moves from high to the low of the day about $3.03. So if we said, okay, the high today is 144.94, I'm going to add $3.03 to that, and that's going to be my target. And then the low today is 141.91. So I'm going to subtract 303 from that, and that's going to be my target exit. In other words, if things don't go according to plan, and I want out, that's the price at which I will exit. So how would we put that trade in? So we could do this buying the stock, or we could do this using an option. And I didn't have these linked. So this is a different story. This is $695, but we have a $500,000 account. So we could afford to risk $680. So let's try this again. We're buying with an OCO bracket. Michael, thank you for catching that. And we're going to put in our exit. It's a market order because it's based on the price of the stock. We want to get out if and or when CVX goes at or above 147.97. And then we also want to exit, and this is another, we're going to switch this and make this a market order also. It's not letting me change this. Okay, you know what? I'm going to put this in a different way. We're going to come here to just buy. And then I'm going to change my single order to a first trigger sequence. This is how I usually put these in. I thought it would be easier to do it the other way, but we're just going to create an opposite order. And this is how I usually do it in the classes because it's just faster. So when I click on my little disappearing, reappearing sprocket on the same page, I can put in both my target and my exit. So I'm saying, hey, if it goes above 147, 67, I'd like to take whatever profit there might be. And if it goes below 138.88, I'd like to lick my wounds and take my losses and exit the position. So we want to buy a call. How much could we lose? $695, all of what we spent to buy it. But we want to exit when it goes above 147 or below 138. And so we would put that in our long call group. And this is our 1 ATR target and exit. Now, we also wanted to have a quick look at the MACD. So if we want to add the MACD, we're just going to type in MACD and we're going to load the MACD histogram. So we're going to add that. We're going to get rid of ATR, although we could see something on the MACD that gives us a confirmation. And could we place a 1 ATR trade? Sure, we could. And if we want to add those little buy and sell signals, can we do that on an indicator like the MACD? We can. So you see it says 1226. So 12 and 26 are the exponential moving averages used to create this histogram. 9 is the signal line, and no means we don't have trade signals. So if you did want to add those, this is, you know, where you do it. And now you can see a little green arrow when it crosses or a red arrow. And, you know, you can use them if you like. It's certainly, you know, not mandatory. But when you see something going sideways like this, you'll often see, you know, it kind of weaving back and forth across this line. And sometimes what people are looking for is, you know, a potential divergence. And so they're looking to see, you know, hey, this is coming down, okay? So it came down to this line here. And this is, we're going to talk more about this next week, but we see something that's come down to here. And here's our MACD. And then this comes down to the same, almost the same price, and yet the MACD is here. So this line is straight, and this line is uptrending. And we call this a divergence. So what this may be indicating is that maybe this sideways trend has kind of run its course. Because, you know, before this was kind of coming down to similar areas when it was staying in this similar area. And now we have this divergence. Now, divergences don't always end up being a change in the trend. But in this case, we did end up having, you know, a change in the trend in that it did break out and has moved to the upside. Okay. Okay, and we can look at, you know, any number of charts. And what I encourage you to do is maybe just bring up the Dow 30 or bring up, you know, any chart and just say, yeah, just bring up any chart and just practice looking at the MACD and then looking at the chart and saying, if I were to buy Meta, for example, and I was looking at it a year ago, when might I have gotten in and where might I have put my stop? So let's say you started looking at it and you bought it here. So you bought it here when it bounced, it kind of came above that line. And then said, okay, well, my initial stop might have been here. You know, and then when might I have adjusted my stop? Well, here, and then here, and then here. And then when did I get out? Well, let's say you got out, you adjusted your stop. Let's say you got out about here. Well, now, is this 30-day moving average acting as support? No, it's now acting as a ceiling. It comes and bonks its head a couple of times. And then when it breaks out, you know, it broke out, we had a 1-day pullback and it came on. Actually, we did place an example trade on that stock in this, you know, one of our classes on this date. And, you know, so you would have maybe made, in this example, a little bit of money here. And now, you know, you got in again. Maybe your stop is, maybe your stop was 3% below there. So it's here. You know, and maybe you adjusted it again to here. You know, so you just have to have a set of rules. And when we look at our MACD, you know, this was kind of uptrending. And then we had this downtrend here, right? Like this is downtrending. But then what do we see happening on the charts? Another divergence. So this was definitely a lower low than this. And yet we have a higher low here on the MACD. And so that can be seen as a sign that, you know, maybe you ought to sit up and pay attention that this trend might be about to change. And did it change on this date? Well, no, but it started to change here. Okay. And then just quickly, because we're almost out of time, RSI is another tool that a lot of traders are, you know, it's a popular tool, relative strength. And if you just key in RSI and import it or add it, and then we'll get rid of our MACD just to keep our chart simple. So we have our 70 line here and our 30 line here. And this is, you know, indicating the 70 line where it may be overbought. So you can see here where it crossed the 70 line up here, indicating that we were in pretty frothy territory. And then it came down. And when it came down to here, you know, right when that, we also had a divergence on the MACD. It also said, hey, you may be oversold. And can you put buy and sell indicators on this index too? You sure can. We can come over here. And, you know, this again says no. This is based on, you know, 14 days of information, 14 trading days. We've got the 70 and the 30 line. And, you know, can we say show breakout signals? Now, there are some who might say, hey, if one is good and all of these, you know, can give us information, maybe we want to put all of these on our charts and work all of these into our trading plan. You know, but keep in mind that some of these are lagging indicators, which isn't a problem, but it is a thing. And that sometimes these indicators can give us false positives or false negatives. And so they don't always come through. And if you have too many indicators on your chart, you know, it can be confusing. And what does the confused mind do? Well, it does nothing. So guys, that's a wrap for today. We've looked at trend lines. We've looked at exponential moving average. We've looked at simple moving averages. We've looked at relative strength, ATR, and the MACD. So I thank you for following us today. Don't forget to follow us in the Land of X, Barb Armstrong CS, and Ben Watson CS. And hit the like button. It helps move this up in the trading algorithm so more people can find this. Don't forget to subscribe to the channel, and please consider attending a live event. I think you'll be really glad that you did. Take care, everyone. Have an awesome day, and we'll see you in a webcast coming up soon.